Welcome back to Click Capital, everybody. And have semiconductors top? I think maybe so. Maybe yesterday could have been a top here. Just looking at the semiconductor ETF, and we're setting up to what could potentially be a bit of an island reversal. And that's when prices break away, gap up, finish lower, then we gap down today and finish lower, creating what's known as a bit of an island there. And this is at really overbought levels up here. And I've just got a list here of the top 12 semiconductor stocks ranked by market cap. And you can see we had some pretty big down moves here today in the sector. And that's typically what you see at the start of a reversal after we've had a big run up and then you get that big down day. That's typically a sign that we may have peaked. And just looking at the price action in Nvidia today, came off pretty hard, over 5%, finishing down near the lows on huge volume, 100 million shares, pretty much double the average volume, which is huge considering the price is a lot higher than where we were a couple of months ago. And once again, huge volumes what you see in reversals, both at the top and the bottom. And if you've been watching this channel, you know I'm still short Nvidia. I added to my short yesterday at 414 up here. And just looking at the weekly chart, I'm looking to hold this short until we get at least a 50% reversal of this move. So that would take us down to somewhere around the 260s. But again, I'll play it by ear, because if the market's crashing, then I'll probably want to hold this longer until we get down into the low 200s, maybe later this year. However, just because it is significantly technically overbought and overvalued in my opinion, that's not stopping the media and Wall Street trying to get you to still buy it. Here's the headline out today: Nvidia stock can still climb another 26% as supercomputer launch solidifies its lead in the AI arms race, Bank of America says. Here's another one: Nvidia stock is expensive, why Citi says it's still a buy. So back to the charts, we can see we are really overbought up here, and you look on our seasonality forecast indicator, we do have a bit of bearish seasonality into the space over the next 5 days, and we can see that in Nvidia as well. And just running through the rest of the sector quickly, looking at the price action, look at that huge shooting star formation we saw in Broadcom, the second biggest semiconductor yesterday. Price ran up to $9.20 a share, then sold off hard in the afternoon, finishing down over 100 points at $8.03 a share. And today we gap down with lower lows and lower highs again. That is a really big topping formation there, and it's still an overbought territory. We can see the candles still completely above the top buy sell band, and this company is reporting earnings tomorrow as well, so maybe we could see a big red down day here tomorrow or the next day. And just going through the rest of the semiconductors, here's AMD on another reversal pattern, off really hard on volume with significant bearish seasonality coming into the stock over the next few days. As Texas Instruments, Intel was the exception today, but that been trading differently from the rest of the sector. When the rest of the sector was ripping higher, Intel was actually coming off, so this today is just more of a correction in Intel. Same with Qualcomm, analog devices, but all the other sectors that had ripped up into this huge overbought territory come off today, like Micron down almost 5%. And again, our seasonality forecast indicators saying that we can expect some weakness up over the next week, and that's based on what the next 5 bars have done historically over the last 10 years. Is KLAC, Marvel ripped huge after its earnings last week, then came off big today, 7.7%. Still significantly overbought up here. Microchip didn't rip as much, but still coming off. And the 12th largest semiconductor on semiconductor came off a bit here too. So back to the ETF, I think we are setting up an island reversal here. I think we've peaked. We got so overbought. The media, everyone, Jim Cramer jumped on it, and now I expect it to have some reversion back to the mean. Maybe we come back down to the 50 bar VWAP over the next week or two. Doesn't mean this underlying trend is over just yet. We may have just seen a bit of a short-term top here because we got so overbought. However, like I said, I'm continuing to hold my Nvidia short here. Another news out today, we got commentary from Fed Governor Philip Jefferson, who's been nominated to serve as the central bank's vice chair, kind of indicating that the Fed may pause at its next meeting in June, but he did say the meeting should not be interpreted to mean that we have reached the peak rate for this cycle. He said skipping a rate hike at a coming meeting would allow the committee to see more data before making decisions about the extent of additional policy firming. And based on that commentary, we saw Fed fund futures significantly decrease the probability that they will hike at the next meeting. Yesterday where it was a 63% chance, now it's 30.9%. And with that, we continue to see bond yields slip a little bit again here today, with the 2-year coming down to 440 and the 10-year coming down to 364. So I think they could pause in June and maybe again in July, but I wouldn't be surprised if we've got another 1 or 2 hikes left in the bag this year. And I agree with what Larry Summers said today. He sees US interest rates heading higher in the short run and US taxes rising significantly in the longer run as the world's biggest economy comes to grips with persistent inflation problem and burgeoning government debt. He said, my guess is that Fed funds are going to have to get to a point 50 basis points or more ahead of where they are now. And I think so too. They're probably near the end of the cycle. They can't go too too much higher because the current rates have already started breaking things in the system like the regional banks. But like Larry said, he said the US is stuck with underlying inflation around 4.5 to 5%. So that sticky inflation still has some more work to do. And as I make this video, Congress is getting together to try and push the debt ceiling deal through the House onto the Senate. It should all get through. The market may have got a little bit nervous about this today, as there's still some politicians on the far right and left that don't like the deal and are trying to block it. However, it should still get done. And what is quite obvious to a lot of us was just confirmed today by Ray Dalio, who gave the US debt deal a D grade, warning it doesn't solve the main problem. And like I said yesterday, it won't make much of a difference. They're just kicking the can down the road. And conveniently, doesn't have to be talked again or discussed until after the presidential election. And because of that huge debt, we've got more and more of the best minds in finance sounding the alarm. And here's Jim Rogers, who I think is a really independent and rational thinker I've followed for a while, and he's saying that the next crash is going to be the biggest one in his lifetime. And he goes on to say, in 2008 we had a bear market because of too much debt. Look out the window since 2008, debt everywhere has skyrocketed. He goes on to say, every country in history that's gotten into this situation has had serious problems eventually. And so it's true, the US government just can't keep racking up this huge debt without it eventually having significant consequences. And so, of course, it'll cause more and more inflation as they print more and more money. And like Jim Rogers, I like agricultural commodities and other hard commodities as a place to park a portion of my portfolio, as a place to find refuge in the coming years. But right now, commodities are having a bit of a pullback as China's manufacturing activity continues to contract for a second straight month. So their 3 years of COVID lockdowns and the West kind of deleveraging a bit from China is having an impact on their economy. And as the biggest consumer of commodities, it does have an impact on commodity prices. Also putting downward pressure on the commodity market is Russia flooding the market with cheap crude, which is at odds with what Saudi Arabia want. Since they have huge infrastructure projects, they need to keep selling the black gold above 81 per barrel like they want in order to meet their budget needs. And the Saudi officials have already started complaining to senior Russian officials and asked them to respect the agreed cuts. And just looking at the chart, we can see crude has come off a bit here today. Now down at 67.5 a barrel, coming up to this big support zone. And I do expect it to find support again because the Biden administration has to fill up the strategic petroleum reserve after depleting it by over 300 million barrels. And the Saudis want it back up to 80, so they're just as likely to be organising another production cut now with OPEC. So I do think this could be a bit of a buy the dip opportunity on oil and oil stocks here. And it looks like Warren Buffett does as well, as he's been buying the dip on Occidental Petroleum and now owns about a quarter of the company after he's been buying up in the last couple of days. And we can see the stock price of Occidental, a similar price action to oil, coming down to a big support level here. And looking at our stock fair value indicator, we've got fair value way higher up at 295. So this company looks significantly undervalued, currently 51 billion market cap, and last year they got net income of 13 billion. So if we see crude bounce off the support here and eventually get back up to over $80 this year, Occidental should rip as well and look really cheap at these current levels. Just looking at the heat map in the stock market today, and a bit of a reversal of the theme we've saw over the last couple of weeks. We've got tech off today, especially semiconductors, along with industrials and finance. And then the more defensive sectors, healthcare, consumer defensive, and utilities had a good day here. On economic data today, we saw an increase in the JOLTS job openings. So that means there's an increase in jobs available in the economy. And another sign that the economy is holding up and the jobs market as well. Also putting downward pressure on crude today was the API crude oil stock change coming in much higher than expected. An increase of 5.2 million barrels of inventory. Then tomorrow we'll be looking at the ADP employment, weekly jobless claims, and non-farm payrolls on Friday. So quite a bit of jobs market data to look at this week. Fear and greed index seems stuck in the greed zone here at 62. Another busy day in the options market with almost 39 million contracts changing hands, 53% of them calls, and once again low put percentages in the mega cap tech. Dark pool index climbed a little bit again today, now at 51% in slightly bullish territory, and corporate insiders just selling slightly more stock than they bought yesterday. Okay, back over to the charts. SP 500 fell today along with all the other indices across the board. Especially the equal weight S&P 500 actually found lows today we haven't seen since March. And there's the NASDAQ index with similar price action to the semis, potentially putting in an island reversal formation here at really overbought levels and looks to maybe have rejected off this resistance zone. Just looking at the weekly chart here, you can see I've got this resistance zone in here. And if you're watching the video yesterday, You know now the NASDAQ has done a 61% retracement from this move from the October low from the November high. So this could potentially be an area where the NASDAQ stalls out and the other indices continue to trade weak with the Dow, mid-caps, Russell and micro-caps all underneath their 50 days. International stock indices continue to come off as well. There's the TSX, the FTSE, the DAX. The Nikkei is still holding up and the Aussie and the China continue to come off. Got a little bump up in volatility today, but still really low. The VIX holding the support zone just under 18. Volatility risk premium hanging in there, just 5 points above realized volatility. And the put call ratio just jumping a little bit here today, but still under 1. And what was significant today was the move up in the skew index, jumping a huge 9% to 158. And this index represents the price of out of the money SPX, which is SP500 index options. So you could think of this as the cost of tailed risk insurance on the stock market. And so going into this debt ceiling deal, there appears to be a lot of out of the money put buying on the S&P 500 here. So the cost of insurance now is really high. Even though at the money options are still priced very moderately, as we can see in the VIX index. Breadth across the market continues to remain weak. Only 28% of stocks above their 20-day average. And looking at on stocks above the 50-day average actually found new multi-month lows here. And we continue to see stocks making new lows. With today, 85 stocks on the NYSE making new lows versus 15 new highs. And 98 stocks making new lows on the NASDAQ versus 34 new highs. There's the growth versus defensive sector spread making a little bit of a reversal formation too. Same with high beta versus low volatility stocks. But small caps continue to trade weak, finding new lows for the year here versus the SP500. And commodities continue to get sold off here versus stocks. Developed international stocks trying to find a bottom here on a little hammer formation versus SP500. Junk bonds starting to come off versus investment grade. And inflation expectations moving back down. With those lower rates, got another good up move in the TLT today. If you've been watching my videos, you know last week I got long back here at this support level as treasuries had been a lot more oversold versus investment grade and high yield debt. And just zooming out to a monthly chart for you, I continue to believe TLT is a good hedge in the typical portfolio of long risk assets, long equities, because the Fed probably is closer to the end of its hiking cycle than the start. And if we do get a recession, they will cut rates and we should see TLT jump back up above 120, maybe into 130 or even 140, especially if we get some unexpected bad news. Will be a flight of safety back into long dated treasuries. So I've been consolidating down here for about half a year. And this is after the biggest pullback that this TLT has ever had in the 20 years it's been on the market. And it's got about a dividend yield of 3% as well. Dollar's still holding at 104, but looks to be stalling out a bit here at this resistance zone. A bit of an overbought level as well, so I wouldn't be surprised to see a bit of a pullback in the dollar. Bitcoin came off again today, down to 27,000. And there's a look at the commodity index today, down 1.1%. We'll just go out to a weekly chart. And it looks to have lost this recent support we've been seeing this year. So we're looking to see whether we can find support maybe around this 2180 level where we last got a turn back here. Gold's still hanging in there though, looking to climb back up to 2,000 an ounce. And remember, we almost got to all-time highs back here, just short a few dollars. So maybe coming up to test that level again. And uranium had a good day, putting in a bullish engulfing candle here on volume. And I don't mind uranium as a long-term play as well. I think the world is coming back to nuclear energy after reversing course for a few years there. If done right, it is one of the most cleanest, effective forms of energy out there. Got a little bit of a turn down here in the AI sector. Clean energy came off a bit. It was about this bit of a dip buy and finished the day above its 50. The IPO sector continues to hold up, along with some of the real overvalued stocks as we can see here in ARK. Retail stocks continue to hurt, finding new lows for the year here. And home builders came off as well, closing down below their 50 on volume. And the energy sector is testing year-to-date lows, but on a bit of a bullish divergence here. You can see on our hidden divergence indicator, we've got a bit of a bullish divergence. Same in the oil and gas sector as well. Could be finding a bottom down support here. I would be surprised to see crude oil trade down into the 50s. I can imagine a lot of people will be buying it down there. And I'd expect OPEC to come out and announce further cuts as well. And there's the exception to the rest of the commodity space. Gold miners here today with a bit of an update on volume, trying to find support here. Regionals had a bit of a tough day, closing below their 50 again. And this price action is looking like it's going to be a hard, long, drawn-out bottoming process in regional banks. And here's the defense sector looking to find support here. There were some worries that they might cut defense spending as part of the debt deal. But last I read, they are not going to cut any defense spending. They're just going to put a pause on all the other spending. So I just put in a support zone here as we have turned at this level before. So we could be at a bit of a support level here in the defense sector. Industrial sector weak. And there's that rotation in the defensive stocks. Here's healthcare with a nice update on volume, which was down from an oversold level here on our buy-sell band. Same with staples and utilities as well. Looking to find support here. And this could be a good level as well at this support, especially if rates coming off. I've been noticing there's an inverse relationship between utilities and rates. So I've been seeing that climb in rates recently, and then they reversed a bit here today. And because you can get a 3.2% yield in the utility sector, which is relatively safe being utilities, it's kind of in competition with government bond yields. And especially if we see a reversal on that rotation over the last couple of weeks into the growth sectors, we may see the defensive sectors come back up and tag their 50 here if the growth stuff has a bit of a pause. The largest asset manager in the world, which I refer to as the BlackRock barometer, and I like to follow the price action in as it gives you a good gauge on the health of the market. As a healthy stock market sees their assets under management grow, however, look at the stock price this year and BlackRock just come off really hard, and that's not a sign of an overall healthy market when you've got the largest asset manager trading like that. And again, today we came off hard on big volume down underneath the 50. Largest bank in the world, JP Morgan, underneath its 52. An exception in the growth space today, Tesla, holding in there above 200 a share, looking to come up and test year-to-date highs. And the $1 trillion club all stalling out today with Apple, Microsoft, Amazon, and Google just all stalling out a little bit. Mixed again in the meme space. And if you're watching my video yesterday, you saw me cover C3 AI, and I called it yesterday. This was a suckers rally. We closed at just under 44 a share. Coming into earnings today, we're actually down 9% before we got earnings post-market. We just got the report, another dismal result as expected, and the stock is off 18% after hours. We're down trading around here 32 a share. And unfortunately, once again, this has sucked in probably a lot of naive investors into all the AI hype. And when you see these little AI stocks like this come off so hard, that could be like the canary in the coal mine. We did see this stock price more than double over the last month, and now we're coming off really hard here in post hours. And just to look at the report, they only lost 13 cents a share this quarter and revenue of 72 million. So once again, revenue is flatlining and the company consistently loses money. So I wouldn't be surprised if this still has a lot further to fall. Over to active stocks today, and we saw Advanced Auto Parts absolutely get bushwhacked, down 35% on huge volume, finishing near the lows. And that's because they came in with a huge miss, only delivering 72 cents a share in earnings when analysts were expecting 256. They also cut their dividend by over 80% as well, and of course the market didn't like that. Hewlett-Packard reported earnings as well, disappointed the market with their guidance even though they beat on estimates. Gap down significantly lower but was dip bought and still finished down 7%. Just had Salesforce report after hours as I speak. They dropped their guidance and the stock is down over 5.5% after hours. Similar story with CrowdStrike, we're down 11% after hours after being really overbought. And once again, seen Anheuser-Busch come off almost 2% today, and Target continues to slide on heavy volume down over 2% today. And there's a quick look at the banks all coming off a little bit here, and Schwab's still trying to hold on to its 50. Okay, back to the main indices. We've still got a big 400 plus point bearish divergence between SP500 and the global net liquidity model. So central banks are continuing to drain liquidity from the system, and that has got to put a bit of a downward pressure gravitational pull on the market. And still much of the same thoughts that I've been having for the last couple of weeks. Still think the risk is to the downside, and I've still got the portfolio position 40% net short. And as long as I keep seeing all these divergences in the market, I'll continue to keep the portfolio tilted net short. And I think tech and semis have stalled out a bit here in these huge overbought levels, so we could see a reversal in all the growth space over the next coming weeks. And that's it for the month of May. Thanks very much for tuning in and for all your support of this channel. I do appreciate that, and I hope to see you again tomorrow.